world. Thank you for joining us tonight. I'm based in Dubai, UAE, so it's nighttime for me. Obviously, if you're in the Pacific or Pacific Standard Time cities, you're starting out your morning. It should be 10 a.m. Pacific your time. I think it's about 1 p.m. Eastern. So I guess good morning or good afternoon, wherever you're calling in from today. We have an amazing session lined up. Well, Alex Morsink is back. He's been on our sessions like 3, 4 times. We keep getting him back because people love him. He's a great individual to explain all things when it comes to fundraising. He breaks all the core concepts down in a very systematic manner so anybody can understand it. So he's back. He's going to be talking about how founders can, determine their startup valuation, and then kind of we'll go from there. He has a lot of great content planned out. While Akshay is bringing up Alex to the screen, we've had about 500 plus people register, so I'm expecting about 200, 250 to show up live. We're at about 125, so I think people will start trickling in. So that's going to be it's going to be a good crowd. But in the meantime, let us know in the chat. Where are you calling in from? I see all sorts. I see Germany, Belgium, Italy, Boston, so Salado, Texas. Awesome. Yeah, just keep it coming in. Dominical from Switzerland, LA, Germany, Tel Aviv. Cool. Is my audio good? Ukraine. That's also one person that said. Okay. Toronto, Vancouver. Perfect. Buenos Aires. Cool. Thanks everyone for joining in. And maybe a very, very international audience. Actually, do you want to bring up Alex so we can kind of get this show started? I guess while Akshay is bringing him up, just again, some housekeeping. Alex will do his presentation. Like always, we'll save Q&A for the end. Please use the Q&A button on the right-hand side of your screen. It's right under the messaging button. Use that, submit your questions. We'll bring it up on stage when it's time. And then I guess the last portion is, there's some emojis at the bottom. You can press 1 for a clap, 2 for a heart, 3 for a thumbs up. If you're liking the content, please let us know using the emojis, because that's how you can give us feedback, right? Alex, are you with us?
I am. Hi, everyone. Great to have you here.
Thanks for coming back, Alex. You think this is your 3rd session with us, maybe 4th of this year. So
yeah,
I appreciate you taking
losing track. I just like hanging out with you. It's just you and me in the chat, and everybody else is around as well.
Yeah, exactly. I think, and you're a very active mentor with FI Toronto. We should get you out here for FI GCC as well, because I'm sure some of the founders will appreciate all the content that you're kind of putting together. Before we kind of begin with Alex's talk, I just want to kind of put the poll up. Let me see this. So, let us know when you're planning to raise your round. Are you currently raising? Are you going to do it the next 1 to 3 months, or after 3 months, or you're still putting it together and you're not sure? Let us know. Okay. So let the votes come in. Alex, can you see the results, or do you want to read it out loud?
It's asking me to vote myself. So now that I've voted, let's see if I can see the results. No, I cannot see the results.
Wow. Okay. Well, it's on this stage, so I'll just read them out to you. About 28% is currently raising, 20% is in the next 1 to 3 months, and 13% is up to 3 months. But about 40% is still like not sure. They're still putting it together. That's where majority of our audience is coming in from. Hopefully that's helpful for you, and I think that this content is very relevant for them. But so you have a 50-50 split of people who are fundraising, and 50% of, I would say in the midst of fundraising, and 50% of the people who are still trying to figure it out. Okay, Alex. I'll let you self-introduce yourself, but apart from that, I'm gonna hop off. The floor is yours.
Perfect. Thanks everyone for joining me. Let me just bring up the screen and let's get the party started. Perfect. Thank you everyone for joining today. We're going to be talking about methods for value your startup. I am Alexander Morsink, a co-founder and managing director of Equivesto. I'm also an angel investor, and I'm a startup mentor / advisor at multiple accelerators and universities across Canada and North America, including Founder Institute. So before I dive in, just a quick, what is Equivesto, my company? Equivesto is a Canadian online investment platform and investment crowdfunding portal. We're licensed in Canada as something called an exempt market dealer, and we help companies raise capital from investors, both angel investors, VCs, and also the general public through equity crowdfunding. Since we launched about 2.5 years ago, we've helped raise over 34 million Canadian from over 4,000 investors. We can only work with Canadian investors and Canadian startups, but that's what Equivesto is. Not here to talk about that, though. We're here to talk about you guys, your startups, and how to value them. So today we're going to talk about 5 different valuation methods, comparables, expected size and stage of companies, using multiples, the discounted cash flow method, and the Chicago method. We're also going to talk a little bit about how valuation methodology changes over time. And by time, I mean the stage and progress of your startup. And we'll also talk a little bit about what I'll be covering in my course with Founder Institute. So this is really a sort of taster piece for the longer 3-hour course that I'll be providing later in June. So we'll talk a little bit about that and what will be involved in that course. So without any further ado, we're going to dive in. Please make sure to put your questions, comments, things in the chat, and we'll address them afterwards in a Q&A session. So before I dive in, I do want to talk about something important regarding the definition of a startup versus a small business. And I like to mention this whenever I'm talking about startup timelines or valuations or anything like that, because technically all startups are small businesses, but not all small businesses are startups. So for the purposes of today's presentation, I'm going to define a startup as a business, a private company. Typically, it's got some sort of technology that's involved in the product or service that they're offering, that's targeting a very large market, addressable market, typically over $1 billion US. And the company is looking to rapidly scale and grow to be able to tackle that sizable market. The company also has some sort of unique differentiator that separates it from competitors, potentially something that's going to help it disrupt the industry that it's playing in. And as mentioned, they're rapidly scaling, typically over 5 to 7 years, to go from a very small business with maybe 3 or 4 employees to a large organization with 50 or 100 employees, really going after that $1 billion plus market. To fuel that growth and rapid expansion, the startup management is planning to raise capital many times from external investors to help drive that growth. As a result of trying to raise that capital, the startup is structured in a way that's going to facilitate that type of investment and make it easier for investors, including planning something called an investor exit, or a sort of fixed target down the road where the investors who put their money in throughout the startup's growth will be able to actually have their opportunity to sell their investment, exit the investment, and get their money back out. Investors who participate in investing in startups are typically looking to do so over maybe a 5 to 7 year time horizon. And so having a fixed moment like an IPO where the startup would go public, or a sale to another larger corporation or something like that, gives that investor a clear visibility of the timeline and the strategy that the startup will be deploying in order to sort of let the investors get their money back out. Now, just as a recap, that's the definition of a startup. A small business overall doesn't necessarily have to be any of those things. It doesn't require technology. It can be a local market focused. Typically, it's owner operated. Small businesses are not always expecting extremely rapid growth or scaling. They also don't need to have a unique selling point. Think of a small business as a local restaurant or bar or store. There might be a restaurant on every block of a city. They don't necessarily need to have one specific unique differentiator from its competitors. Also, typically small businesses are not planning to raise capital through issuing equity to investors. So they're not planning multiple raises, diluting the ownership, and they also then don't have a large planned investor exit down the line. Now, the reason why I go over these two definitions is what we're going to be talking about today. How to value your business is going to be assuming that your business meets all of the definitions of a startup. We're not talking about the methodology of valuing a small business. I do know how to do that, and Equivesto does that as well for clients. But that is not something that today's presentation is about. The methodology is different. The things that investors might look for is different. And even the type of people who would invest in small businesses is different as well. So in today's conversation about valuations, we're focused entirely on startups, specifically startups that are looking to raise capital multiple times, from potentially angel investors, venture capitalists, and then are looking to have that exit opportunity in 5 to 7 years. So I wanted to make sure to clarify that first. So let's dive into the first valuation method we're talking about today, which is comparables. Comparables is the easiest or potentially the fastest valuation method to use. Essentially, you find other startups in the same industry as you with a similar stage and or size as you and try to figure out their raise terms and valuation that they used when they raised. And then you would modify that valuation up or down based on differences between your two stages, differences in the market, the risk level, the team, traction you might have, etc. So it's essentially just looking around to see what other people who are kind of similar to you are worth and trying to use that as a goalpost or a marker. So one benefit of using the comparables method is it can be helpful for pre-revenue companies. So if you don't yet have revenue that you can use to sort of try to support your valuation, you can use the comparables method. It's useful in when you have a wide industry with a lot of other startups in it, where you can make easier sort of comparisons. And it lets you also leverage the social proof of other investments that have taken place and the impact of other VC investments. So if you see, okay, you're in the space is getting a lot of traction, other companies operating in the space are getting these kind of valuations, and from these types of VCs, you can leverage that in your conversations with investors to say, hey, we're not a direct competitor to this other business, but we're in the same kind of space and we're doing something unique and interesting, generating some value. And clearly these VCs see value in this space. So we're trying to create some value as well. Some of the weaknesses of the comparables method, as I'm sure you can surmise, is it really removes some of the core differences between companies. You're trying to just say, oh, I'm a fintech company. This guy's a fintech company, so we should have a similar valuation. It also, as part of that, assumes that all of the companies are equally competitive and are similar and sort of can operate with similar potential for success in an industry. And the biggest weakness, however, is it only is useful if you have adequate enough information on your industry and if on specific raises as well, and if the raises have been done recently in similar market conditions. So with what has just happened currently at the beginning of 2023, in the sort of VC early stage funding market, there's been a strong sort of collapse in valuations, and the frequency of rounds have really gone down. So if you went out to look for a recent round that was done for your clean tech company, there might have only been a round done for a pre-seed or a seed clean tech round that you can find on Crunchbase back in maybe October of 2022 or something like that. Now, something from 2022 would be before this collapse in valuations. So trying to use that valuation from October 2022 or June 2022 would not be an effective comparable at all, because the valuations have really fallen and you will most likely not be able to get that same type of valuation for your business. So you really need to look and see if the market situation is the same as the time of the investment where you're trying to make the comparison. But for example, right now, as we're going through 2023 and sort of valuations have fallen, if you're able to see a valuation from last week from a venture capital firm or something in your space in a similar area, that could give you a sort of marker or an indicator if you're a similar stage as that company. Okay, this is kind of where the market is right now. I should keep that in mind when thinking about my valuation. So the next method is benchmarking. Now, again, with the current change in valuations, these benchmarks have moved somewhat. I also want to mention, when looking at this slide specifically, because I know many of you will gravitate towards this slide when the deck goes out afterwards, everyone's going to focus on this slide and try to use that for their valuation as well. This is very overly general. Again, to even fit in any of these benchmarks, you have to meet all of the requirements of a startup that I defined earlier in the presentation. But also, these stages and the valuations and raise targets at these stages are also highly different country to country, and also obviously dependent on market factors. So as you can see here, the beta stage, you're just getting started, you're pre-seed, you probably have less than a $3 million valuation and you're looking to raise less than $1 million. Again, this sort of label and this sort of stage, even the definition of what is a pre-seed round would not be the same in the United States as it is in Canada. So Canada, what would be described as a Series A would probably be described as a seed round in the United States, because the United States grows companies faster, larger, with higher valuations, raising more money earlier. So a later stage company in Canada would probably be closer to an earlier stage company in the United States. Now, that might be similar if you're coming from the UK or Switzerland or France or Tanzania, wherever you're calling in from. You do want to think about how this chart would be modified to match your local sort of startup venture capital ecosystem. But just as a generalization, typically we see, when companies around pre-seed, beta stage, roughly $3 million valuation, $1 million raise at the minimum viable product. So the beta stage, you're really just creating, you're still building your technology. The MVP, you've finished building the minimum viable product of your product, but you haven't actually rolled it out and started selling to any clients. So this sort of seed stage, you might be between a $3 and a $10 million valuation and a $1 to $3 million raise. But again, this definition of seed would not necessarily be the same as in the United States. Seed companies in the United States can be much later with larger valuations. But again, current market trends have really impacted that quite heavily. The next stage is the product market fit stage. So you've completed your product, you've started going out and getting some traction in the marketplace, you've started to get some real serious sales. Typically, getting to Series A, you need to have at least $1 million in annual revenue to qualify for Series A. Sometimes it's even a little bit higher, between 2 and 3 million, to qualify as a Series A raise. But in that situation, you're looking at between a 10 and a $30 million valuation, raising between 4 and 10 million. And then you move into the scaling stages. So Series B and beyond, much higher valuations, much higher raise amounts. And then finally leading towards the exit. This whole timeline has really gotten sort of jumbled up with the current market trends because the exit that people are looking for has been delayed. There's not very many IPOs going on. The IPO market is kind of shut down. That has put downward pressure on every other stage. So later stage, Series B, C, D, companies are having real trouble raising rounds there. Valuations are falling there. That pushes back down on Series A, pushes on seed, pushes on pre-seed, just like that. So remember, This is overly general, and it really depends on making sure you are a top performing startup, but also this chart will be very different country to country as well. Another valuation method for your startup would be the multiples method. So with the multiples method, you're essentially looking at other this is post revenue, of course. You're looking at other companies and the valuations that they have in the same industry as you, and if those valuations are a consistent multiple of something on your income statement. So, for example, okay, everyone in consumer goods, their valuation is typically 5 times or 10 times their annual revenue. Now, that's not what it actually is for consumer goods. That's just an example. But the idea is there's certain industries that have standardized multiples. So you'd say, okay, every large fintech is usually worth 10 to 15 or 30 times their annual revenue, or their EBITDA, or their net income, whatever it is. You would learn the multiple for your industry, the multiple of existing public companies in the public market, and then you would look at your own balance sheet income statement and simply apply the sort of industry standard multiple to your own documents to see where your valuation would show up. So this valuation methodology is quite valuable for later stage businesses that are preparing to raise a series D, a series C, or eventually IPO. And this is useful because it helps visualize the exit potential for investors, right? Investors are exiting potentially when a company IPOs. When a company IPOs, its value is going to be tied to the standard industry multiples. If you're out looking at the public market, every single large car company has, a 5 or 6 times revenue multiple, and that's how the value of car companies are typically determined. Your private car company, once it IPOs, will probably be valued based on a similar methodology. So if you're using that for your startup now, the investors will be able to see, okay, when we really grow the business over the next couple of years with this investment I'm going to make, and we do have our exit in 3 or 4 years, this is what that would potentially look like. Some of the weaknesses, though, of using the multiples methodology is it's only effective with later stage companies that have clear revenues, EBIT, and traction. It's not effective at all with early stage companies, and of course, doesn't work at all with pre-revenue companies. Another weakness of the multiples methodology is if you use top line multiples like revenue or sales, you're ignoring key differences between companies, including profitability, team strength, and other areas like that. So unless you really are a later stage company that is preparing to move towards an IPO or something like that, I would probably try to stay away from using top line multiples. If you did want to use a multiple, use something more like EBITDA or net income that at least can demonstrate, the profitability that you do have. Investors these days have really pivoted away from growth at all costs towards making sure companies can grow efficiently and profitably. And so when you're setting out to raise money right now, one of the first questions that investors will probably have for you is, are you profitable right now, or what's your timeline to profitability? So being able to have something like that that's reflected in your valuation will be a benefit to you. So here's another methodology, discounted cash flow method. Basically, with the discounted cash flow method, you're taking 5-year annual financial projections of your business that are realistic and have very strong logic-based assumptions. So with DCF methodology, it's very, very important that when you're approaching creating your financial projections, you do a very, very good job of generating them. So you're going to use assumptions. You're looking into the future. No one's necessarily expecting these projections to come true. But at the same time, the quality of the assumptions you use and you put into these projections is going to determine how useful they can be for something like this, for evaluation determination. So an example of this would be with marketing. So if you simply say, okay, my revenue is going to be $1 million in year 3, I'm going to just spend 20% of my revenue on marketing. That's my marketing cost. That is a very, very weak assumption. Instead, what would be a much higher quality way to approach it is to say, okay, in year two, my goal is to, or in year three, sorry, my goal is to hit $1 million in revenue, or maybe year two, or whenever it is. For me to get $1 million in revenue, I need to get how many clients at this dollar per client? Okay, for me to get that many clients, how am I marketing and bringing in those clients? What is the current, is it social media? Is it going to business seminars? Is it paying salespeople? You figure out your sales pipelines that would work, and then attach assumptions to those sales pipelines that have been proven. So you'd say, okay, I'm using social media marketing. The cost per click for ads in my industry is typically 50 cents per click. I'm expecting a click-through rate of X. I'm also expecting a conversion rate from somebody who clicks the ad to somebody who actually signs up and becomes a paying customer to be, I don't know, 1%, 0.5%. Again, whatever the sort of standard assumption for the click-through rate is. And so to get to $1 million in revenue, I need this many clients at this price point. And to get that many through my marketing channels is going to cost me this amount. That sort of assumption shows much more detailed thought into the analysis of the business, rather than simply saying, oh, we're going to expand the number of employees we have every year by 20%. It's instead saying, okay, in year three, we want to spend an additional, $5 million on the development of our technology because I want to build these 4 things. And so I'll need to hire 3 developers. This is the average rate for a developer, and they'll take these stock options, something like that. The higher quality financial projections you can make, the better and more effective using a discounted cash flow method can be on your valuation. So once you've got your future projections, we're essentially going to take the net profits every year over the 5 years and discount those annual cash flows back to the present date using something called a discount rate. When you add those values together, that is your post money valuation. And then if you subtract the investment money needed to make that happen, that is your pre money valuation. So I have the formula here on the slide. You can also Google discounted cash flow method to learn the formula. But the discount rate, choosing the discount rate is very important. Typically, in a traditional financial model, the discounted rate is the cost of capital. So if you're borrowing money to fund the project, the interest rate that you have to pay to the banks. However, for a startup, the cost of capital is much, much higher. So I recommend for your projections using a discount rate of 50% or 70% to at least see what things look like, and just sort of get an idea of what the value of the business might be. So why use the discounted cash flow method? You can use it for earlier stage companies, but it really does depend on using the discount rate properly and effectively, and also having really high quality financial projections. A benefit is it really allows for differences in how the company will be run in terms of profitability, when you're spending on which things, to have an impact on your value. And a really strong benefit is it includes the long-term potential as outlined by the founder. So part of what's important is, certainly with an early stage business, you don't necessarily have any value. It's really about the value you can create in the future. And using discounted cash flow methods, it's showing you your vision of year 5. Again, likelihood of actually achieving that, essentially 0% or very, very low. But what it does is it's a very effective way to represent to people and include in your valuation what you're believing that it will become. Now, some of the weaknesses of using the DCF method is, again, it really relies on the quality of the financial projections and the underlying assumptions. The discount rate choice, the percentage you choose, plays a major factor. So if you choose 20% versus you choose 70%, your valuation is going to be like 5 times different. And investors need to understand that the projections you're preparing for this are not a promise or even an expected outcome, but are a logic-based vision of the potential of the company. You don't want to be preparing projections for this. Give those to an investor. They invest in you, and 3 years down the road, that investor tries to hunt you down because you haven't hit your projections for year 3. Any sort of projection created by a startup needs to be taken with a grain of salt. And as an investor myself and someone who structures deals, I expect these projections to come true 0% of the time. What I want to see from the projections, though, is the vision of the founder, the potential they see in the business, and if there's logic and good financial assumptions to back that up. And that helps me understand the value in that business. So it's important, if you do use this method, to make sure your investors also understand what you're providing to them. And the last method we're going to talk about today is the Chicago method. So the Chicago method takes the discounted cash flow method that I just talked about and actually applies it to 3 distinct financial projection scenarios, and then multiplies them by their likelihood, by their probability. So essentially, the detail you just put into your financial projections, you do that 3 different times. 1 best case scenario, 1 middle scenario, 1 worst case scenario. And then you basically apply a probability of each of those scenarios happening, and then multiply the value of the company by the probability of that scenario, and then add that together to create your overall valuation. Now, this is a highly technical method. So you have 3 different sets of 5-year projections with relevant assumptions. So it's a lot of work to do the Chicago method, but it can provide a lot of really robust data for people. But again, it still relies on all of the strengths and the weaknesses of the discounted cash flow methodology. And of course, for companies that are earlier stages that don't have any revenue, you can use this methodology. It's entirely based on future projections, but there's no method for you to really tie your assumptions that you're using to your direct personal reality. So the more traction proof points or assumptions you're able to include that are based on assumptions you've discovered about your unique business, the more valuable any of these methodologies become. So there's a few important things to talk about overall when thinking about how to value your company and different stages for your business. So as I talked about a little bit earlier, the way you value the company is going to change over time. Earlier stage companies have limited or no revenues, and so valuation must be based on the future potential of the business. Later stage companies, which are moving towards an exit or IPO, their valuation will be more in line with the methodologies used to value public companies, because private equity firms that are investing in these businesses will be looking very much to how those same companies will be priced when they plan to exit, to make sure that they can get the returns that they're targeting. So for that reason, revenue, EBITDA multiples become quite standard as a valuation methodology when companies get towards later stage. It's also much easier to do at that time because the company's been operating for a number of years and should have multiple millions in revenue for multiple years to really sort of look and see a clear trajectory. Earlier stage valuations are much more variable. And you might want to leverage multiple of the methods that we mentioned here to make sure that they all line up. Typically, I would start with the discounted cash flow method to sort of look internally and see, okay, what numbers am I kind of getting? And then I'll look at all of these different comparable methods to sort of see, okay, am I in the right ballpark? Does this sort of make sense? Am I out to lunch? That helps sort of frame things. Finally, valuation methodology is highly subject to overall market changes and country-specific market changes. So I talked about this a little bit earlier, but a seed stage company in the US would potentially be worth 15 to 30 million. Again, with the current decrease in valuations, it might be half of that. But in Canada, a seed stage typically means something different than in the US. And so Canadian seed stage companies typically raise between $5 and $15 million valuations. But again, with the market changes, assume half or maybe even a quarter. So valuations have reduced drastically as part of this change. And I think the most important thing to keep in mind is, for a startup, because you don't have an operating business that's generating profits, there's no one true valuation for your business at the moment. Well, actually, there is, but it's probably $0. So when creating a valuation for a startup, you're typically looking forward at future potential. And as soon as you do something like that, it's very much going to be beauty is in the eye of the beholder. So what I mean by that is you need to find investors who see the value in your company to support the valuation that you're looking for. You want to make sure it's roughly fitting what's going on in the market currently. So it's easier to find investors, but it really does become making sure that you as a business and as a founder are able to connect with investors that see the same potential in the business that you do. And the valuation itself, it doesn't matter what valuation you set when you go to raise a round. The valuation is only actually locked in place when somebody transacts and actually invests in your company at that valuation. That's when you actually do and you have sort of earned that valuation. Until that time, it's you just picking a number. And I'm sorry, having a friend invest in your business at a valuation that you have set isn't necessarily going to be that sort of indicator that other investors might be looking for. It's really when an external investor comes in, reviews all the information, and decides to invest. That valuation is really going to be the line in the sand showing you what someone is valuing your business at. So we've kind of covered 5 different valuation methods, but we've really just sort of been scratching the surface of startup stage valuation, planning your round, how to structure your round, and all of these sort of other pieces. It's not as simple as saying, it's worth $4 million for my business today. I'm going to go out, I'm going to get $4 million and get started building. Especially right now during this current market change, deciding how you're setting up your round, what type of vehicle people are investing in. Are they investing in equity, in ownership directly in the business? Are they investing via a safe note? Are they investing via a convertible note? What you choose and how you set up the round based on that choice will actually have a very strong impact. In Canada right now, when I talk to a number of investors, there are still sort of larger venture capital firms that invest and use safe notes in Canada. But a lot of the angel investors currently won't even look at deals that are using a safe note. So depending on how you set up your round, you may have accidentally locked out or decided against a number of different investors. Some terms would be expected or sort of demanded based on this current situation, while others would not. So that's one of the things that we're going to spend a lot of time on in the longer session. We're also going to take a deeper dive into these different valuation techniques, when you're using them, how to set them up for yourself, and some exercises to actually help you come up with some core sort of baseline valuations for your business. Also, we're going to talk about building a financial model and a budget for your business. One of the big changes that's come over the last couple of months is profitability versus growth. What's important to investors, and how to set up your business to do that. But also changes in the strategy of how frequently are you raising, how frequently are you going out to get more capital, and so how are you setting up your burn rate? What I mean by that is, okay, you've raised $1 million. How are you spending that $1 million over the next while? Is that going to last you 1 year? Is it going to last you 2 years? What are you spending the money on? How to strategize that and plan the timing of potential future raises so that you don't run out of money in the middle. That's going to be a very important area. And I'm going to talk about some changes that we're seeing in the VC space this year. That's going to have a really huge impact next year, and on rounds you might want to do in the future. So that's an important part of our conversation in June. And then, of course, talking about dilution. The biggest question for founders, and that's why it's called the founder's dilemma, is, how do I keep control of my business, or should I keep control of my business as I continue to bring on more investors and raise more money over time. So we'll have considerable conversation about that, about dilution, how to plan for it. How does dilution actually work? If you own 100% of your company and an investor comes in and buys 20% of your company, and another investor 6 months from now comes in and buys another 20% of your company, you do not have 60% of your company. You have more like 72%. So how does that math work? That's what we're talking about with regards to founder dilution. Thank you very much for joining me for the 5 different methods for valuing your early stage startup. I would love to answer your questions in the chat, and you can, of course, learn more on the Equivesto website and the Founders Institute website there. And I hope to see you in June. Thanks.
Awesome, folks. Alex, I don't know if you're seeing the emojis. It's going crazy. Who would have thought like you get this much love and attention for talking about startup valuations? You've made it.
I
Like,
know.
this is
I know. It's crazy.
this is the
Thank you
stuff.
very much, everyone.
This is the stuff we geek out at, like dinners and stuff. Awesome, Alex.
Mhm.
Thanks so much. This has been very helpful. I know as a startup founder, like navigating this has been very, very. I don't want to say traumatizing, but very
It's been
challenging.
traumatizing to me. It's been okay.
Yeah.
Just this is just between you, me, and the 250 people in the room. This, don't include this in the rest of the recording, whatever. But like, as an investor, I'm going out and I'm a member of a local investor network. I'm going to meetings, and like, it feels like sometimes the wheels have come off. Like, I'm there and a company's pitching and the company has $1 million in revenue and they're asking for a $6 million valuation, and the investors are not excited. And that is terrifying to me. I'm like, holy crap, what is happening? Like, something is like totally messed up here. And so I understand, both as a founder of my own company, as a financial service company that helps structure deals, but also as an investor, that this whole situation can feel very daunting. Even if it wasn't sort of a valuation collapse period, being a founder is a lot of work. So I want to try to empathize and help support as much as I can.
Perfect. Yeah, thanks. We'll just jump into Q&A. There's a lot of questions that are there. So folks, we'll probably do the top 5 questions. Please go into the Q&A button and upvote some of your most popular questions. And then I want to make sure we have enough time for some networking, so Alex and I can just kind of see you on the tables. But before we do that, let's just quickly talk about the bootcamp. Alex, you talked about what you're going to be covering. It's everything
Yes.
around valuation and dilution for founders.
Yeah.
Sorry, your screen is no longer showing, but
Okay.
I just want to summarize it for the audience.
Perfect.
And then it starts in a couple of weeks. I threw the link up. I'll throw the link again for everyone, just so people see it. Show on stage. Just go check it out. Apply now, or like finish the registration. Early bird is $3.99. We're going to cap it eventually at about 20 founders or maybe 25. And then a couple of weeks it goes to $6.99. So there's about like a $300 difference. So like, if you're interested, just go and just to sign up and kind of proceed with that, because we anticipate that this one's going to be very, very busy with a bunch of other founders like jumping in to answer their questions about like dilution and valuations and stuff like that. So Alex has put together a really, really good curriculum. I encourage you to go check out the landing page, scroll to the midway portion and look at all the content that's being covered. And then if there's any questions, feel free to reach out. I'll stick around as well after this too, if there's anything else. All right.
Yeah, the goal is really to sorry, I hand just quickly. The goal is really to create a lot of value for people. Typically, a 1-hour session with me just at my consulting rates is $500 an hour. And so we really wanted to try to jam pack as much value as we can into the 3-hour session. So it's a 3-hour whole thing with lots of time for sort of Q&A, but then also we give you some sort of like questions, some homework, and then we have a review session the next week to sort of go through it, take it up, sort of answer your questions. So the idea is to kind of give you like 7-8 hours kind of time and like thoughts and planning and everything but really, you're not you're not paying ridiculous fees for that is kind of the idea. And FI was the perfect partner to sort of do this with.
Yeah, I appreciate like Alex also giving his time for this. We really the gap we identified is like all was on the founder education. It was like these complex topics like valuation and dilution. We need a little bit more support, which is why we put this together. All right, let's kind of jump into the Q&A. We got some popular ones, so let's come up. This one is from Miguel. A lot of people have voted this. What's the best place for people to get data for their comps analysis?
Yeah. Yeah, it's a great question. Obviously, everyone knows about sort of Crunchbase and PitchBook and sort of all these other kind of listing locations. You want to try to start there. That's going to be the easiest place to try to get some information. And then what you're going to probably want to do is match that with that chart that I have in terms of the stage. And you're going to want to think about traditionally when a company goes out to raise like a structured round, a round that they would post on Crunchbase or something like that, they're typically raising between 10 and 30% of the value of the company. So if you see somebody, like they're never going to post their valuation, but they're going to say how much they raised. So if they say, okay, they did a seed round and they raised $1.5 million. So you're going to be thinking, okay, $1.5 million is somewhere between 10 and 30% of this company's value. So they're somewhere between, maybe 6 and 15 million is somewhere where they're going to sit. And then you'll look at the timing of when that happened and all that sort of stuff and say, okay, this is clearly, I'm in the right ballpark kind of a thing.
Perfect. I'm just going to keep burning through this. I want to try to get through as many as possible and also give a few minutes for networking. Zainab is asking from Dubai how to raise money without losing so much equity or risking the extensive dilution.
Yeah. So this is one of the big topics of the boot camp that I'm going to sort of talk about. But essentially, like as a founder, you're going to give up ownership of your company. That's part of what you trade for getting money to grow your startup, and that's part of the startup journey. So at the end of your startup journey, you should not expect to have more than maybe 25 to 30% of the value of your business. That's what it is to be a startup founder. From a founder to all of you, I own around 25% of my company. That's how it kind of works as you raise capital. What is important is figuring out, okay, the difference between ownership and control, totally different things. So we'll talk about that, but then also, okay, who are you bringing in, the strategy around that. It's not me versus my investors. It's how to get everybody on the same team so that you're all working together for the betterment of the business. So that's a really important topic area. And I spend like 35, 40 minutes on that alone in the boot camp.
Perfect. Let's keep going. VJ is asking, who sets the valuation, lead investor or the founder? This is a good one.
Yeah. So the best way to think about it, VJ, is you're trying to sell something. I'm trying to sell you a pair of shoes, right? You have to put a price sticker on the shoes when you go to the market. But if you go to the market and you say, oh, these flip-flops are worth $250 and nobody buys them, you haven't put a good price. And so anytime with valuation, it's a negotiation. But you as a founder, you have to sort of put the stick in the ground and say, this is where I think our valuation is to start. This is where I think I'm at. And then there will be back and forth with the investor. The lead investor, other people are looking on to sort of be like, okay, this is a trusted investor who has done the real deep due diligence to help set that valuation. So another investor is going to look and see who is the lead. Have they agreed to this valuation? What is the valuation that the lead thinks makes sense for this deal? But at the end of the day, you as a founder choose to take their money. So if a lead says these are the terms that I like, you as the founder can say, no, I don't want your money. Like don't forget, every business can be bootstrapped if you happen to be very rich yourself, which I am not. So I had to go out to raise capital, and that's why we're all here. But technically, it's your business. You can choose what to do with it. If you need capital to grow it, you could choose to not do that. You could choose to shut the business if you don't like the terms that the investor's coming at. But it's really a negotiation and an agreement.
Perfect, thanks. Folks, there's a lot of questions in here. Obviously, we won't be able to go through it. So I'm just going again, I'm going from the top to the bottom. There's two more
Yep.
questions, and then we'll kind of jump into the networking portion. But some good stuff here. So Afwaz is asking, you talked about these different valuation methods, but like, what are the top three key metrics that they all kind of rely on?
Yeah, so I think what I would actually do is tie it back to some of the core definitions of what makes a startup versus a small business. Because again, all of these valuation methodologies are assuming you have a strong team. You are building a technology-driven startup in an industry. You have something that's disruptive, that's disrupting that industry. You're targeting a multi-billion dollar addressable market with some sort of product or service. You have completed, you completed most of that product. You're ready to go to market. And then what would change or differentiate your valuation from there is going to be strength and experience of the team, including things that you've done previously. It's going to be traction or success to date. So, okay, how many people do you have on your wait list? How many letters of intent do you have signed with clients? How much money have you made so far? Anything that gets you closer to a profitable business that's making lots of money and doesn't need to raise money again, that's going to make you the most valuable. So if you just work your way back from there, that's going to sort of, those are kind of the core things. So it's not like every business needs to have 3 advisors who sat on the board of Google. That's the secret sauce. It's one of those kind of like silly things, but it's relatively simple. Build an absolutely fantastic business and make lots of money, and then investors will want to invest in you. That's it's everyone's like, well, that's very obvious, and that's what we're all trying to do. And I agree with you. There isn't some sort of magic bullet situation where it's like, okay, I just need to do this thing, or like it's really my price ratio or something that's going to help drive a higher valuation. It's just you want to focus on building that strong business.
Yeah, that's a very, very good piece of advice. But like, it's generic, but it's also like you need to make sure that you always adhere to the fundamentals. All right, let's do one more, and then we'll break out into questions. I saw a really good one here. Oh my God, where'd it go? Here. This one. Christian from Bellevue, US, the United States, is asking like, how do patents and other modes to competition play into valuation? So if you have maybe IP, or if you have something that's super juicy, can that actually impact your valuation because you're the only one that has it? That would be a good question to answer.
Yeah. So it's a great question. And so this does tie back to a little bit as what I consider sort of like a minimum requirement to play in the space. If you are like, if I bring to somebody an app and I say like, hey, I am making the next, ride share app. This is an amazing ride share app. It's going to be incredible. The first thing the investor is going to do is say, okay, Uber and Lyft are already there. And there's a Chinese version. There's like, there isn't like what is going to make you different or make people want to use this, and the answer would be nothing. Then my valuation would be 0. So to even get to this point where you're getting the valuations that I've outlined sort of in my chart or any of these things, that's assuming that you have already a highly unique, differentiable product that has some sort of moat. If you come with a product that has no moat, you don't get any of these valuations. You're more of a small business, so the capital raising structure is going to be different. You need to have that to kind of even get your pieces on the board or play the game. Now, within that space, if you have something even additionally highly defensible than that, then that plays into the variability with valuation. So with any of these methods, you're generally coming to a rough range. So if you're saying, okay, it seems like our competitor that is not as well positioned as us, they seem to have raised between a sort of $6 and an $8 million valuation, then you lean towards the 8. But again, it's going to come down to the negotiation with the lead, and the lead's going to sort of say, okay, look at this IP. Do I agree with it? Do I think that it's, worth this 8 or is it worth 6? And kind of go from there.
I think that was perfect. I wish, Alex, we could just keep you here for like 6 hours and burn through the
Well,
50 questions.
you've got me for 3 hours and more in June.
Yeah, I guess that's there as well. Folks, thank you so much. Alex, thanks for taking the time. Any last piece of advice for the founders on the call today that, again, most of them, 50% are planning to fundraise, but any last piece of advice you want to kind of give to them? And then after that, we'll break out into networking.
Yeah, focus on the core fundamentals of the business, making sure you're building a business that's going to last and is going to be able to have a really strong like business revenue model where you do the thing and it generates you good revenues. A lot of companies go out to raise and do the whole, venture capital, multi rounds exit. That's why we're having this discussion around valuations to talk about that. But don't forget that if you build a really great business, it's possible for you to grow through your own revenues. And that type of a growth model typically was not as focused on as much because everyone was growth instead of profitability. But certainly right now, in the space that we're in with the current market situation, there's a lot to be said about growing successfully on your own, getting some revenues, using those revenues to grow your business, and then instead of trying to raise at a pre-seed, seed, series A all the way up, you just kind of get things going on your own. And then you show up to the market with $1 million in revenue and you're profitable. You're going to get a lot of people's attention at that time, and you'll be in a better position to get, really positive terms. I know from the perspective of a founder, it's always like, if somebody just gave me $5 million, I could just build all this and do it and it'd be so much easier. And I agree with you. But the reality is, investors don't want to give you money to build your rocket. Investors want to buy a ticket on the rocket as it passes them to get to the moon. And it's frustrating. And you're going to say, well, where are the people who want to help build the rocket? And I don't know. I haven't found any. So you always want to try to build as much of the rocket yourself as you can. And when approaching investors without lying or misrepresenting things, you want the feeling to be the rocket is taking off, whether you're on it or not. Do you want a ticket? That's the feeling you want to give.
Perfect. I think that's a perfect way to end this session. Folks, thank you so much. Hopefully, you'll stick around for the networking. Show Alex some love. Connect with him on LinkedIn. He's a great resource. He's a great mentor. I think just keep in touch with him. And yeah, hopefully, we'll see you in the networking table. With that being said, enjoy the rest of your afternoon, evening, wherever you're dialing in from. Thanks, everyone.
Thanks, everyone. Bye.